Jobs Act, which the new OBBB Act, makes permanent. And you see, we have the benefit of those expanded tax brackets and not getting into like the 35 or 37% bracket, married filing jointly until you're over 500,000 of income, 37% bracket, over 751,000 of income. And the additional capital gain rate of 15%, which applies to the 22 to the 35% bracket. So from a capital gains standpoint with our clients, you're not going to get into that 20% capital gains rate unless your client is in the 37% bracket. So opportunities to lower taxable income. Put together this chart here where it was just kind of like a list. I thought this would be helpful, and I'll put this as an addendum to the tax facts. It's just a list of all of the items or income level phase outs, that were in the OBBB. And so starting with the senior deduction there, where
Lincoln
it starts
Financial
to phase
Group.
out at
We're on a
$150,000
recorded line and
and then
information is
fully
being
phases
collected.
out at
My name is
$350,000.
Dan. May I have your first and last name, please?
Hey Dan, Matt Donovan.
If you just put your mic on mute, please. Thanks. And the auto loan
All right,
interest
may I have your
deduction.
telephone number, please?
Hey everyone, this
781.
is an important meeting.
Excuse me,
If
789.
you're listening, please mute your mics. It would be greatly appreciated.
All right, so auto loan interest deduction, that phases out pretty quickly between married, I'm just going through married filing jointly right now, 200 to 250,000. And you can see the corresponding phase outs for a single taxpayer on the right-hand side. No taxes. I thought these were interesting. No taxes on tips or overtime income deduction. Look at the phase outs between 300 and $550,000. So I don't know. Maybe I'm just being stereotypical, but I think that people who are getting tips and overtime, they're usually not, making that much money, but maybe I've got it all wrong. I don't know. But or maybe it's, you got a combined households too, different spouses working. But I just thought those limitations, those phase outs were pretty high. And so then you've got the qualified business income deduction, which pretty much stayed the same. That 20% deduction for flow-through entities like S corps and LLCs. So married filing jointly starting at 394 and fully phasing out at 544,000. Child tax credit, 400,000 to 444,000. And then you've got the state and local tax deduction. This is interesting, thereby, the reason for having a red box around it. I wouldn't, it was pointed out to you, but also the red box tells me to make a point about it, right? So the state and local tax deduction, so that's 40, so it went from 10,000 to 40,000, right? So I'm starting to get a little excited about it because I live in New York and we've got high taxes. And so $40,000. But look at that, married filing jointly, you can take up to that $40,000 deduction if your income is below $500,000. And it fully phases out at 600,000. But the interesting point there is for a single taxpayer, it's the same limitation. It starts to phase out at 500,000 and then fully phases out at 600,000. I'm not really sure why that was done that way. Maybe it was done that I know that there's a lot of planning opportunities that are being talked about with using the state and local tax deduction with like non-grantor trusts. We're going to talk about one or two of those today. But I thought that was you usually don't see the same phase outs for single and married filing jointly taxpayers. And then we've got the alternative minimum tax. Remember that nasty beast that was around with like lower phase ins where, even if you were just like a middle income, you're subject, if you had high real estate taxes, high state income taxes, you were paying AMT and you weren't making that, you were doing well, but you weren't making that much money. And so they raised the limitations. They raised the AMT exemptions, and then the phase outs were higher than $1 million for married filing jointly. So they did reduce those a little bit to 1 million and then fully phase out at 1,274,000. And then they increased how fast you kind of phase out, over that period. Just go into the questions just for a second before I move on. Will Amy, good question. Will the slides be posted on integrated connection? Yes, they will be. I just want to submit these to compliance first because they're just in case you use them with clients, and you probably will use some of the slides. They haven't been fully compliance approved yet. So once they are, I'll post them up in the integrated connection, but the video will be up there of the recording of the session as well. Another question from Sharon is any chance that the phase outs for salt is a true error in the bill that will be corrected later? I saw the Secura initially. Interesting point. I think that I haven't heard anything that it was a mistake. I think that maybe it was done that way because of, because of maybe because you're going to have, high income tax, high real estate taxes or income taxes, with, it's real estate taxes, for a lot of states where you're a single family owning a home, rather than a married couple. So maybe it was done for that reason, but I'm sure there'll be some clarification that'll come out. But, there's always the chance that it could be corrected. Well, we just had a little rumble. We've had a couple of little earthquakes here in New York lately. So yeah. So which is kind of odd, right? So all right, back to the presentation, standard deduction. So standard deduction, you can see here, I thought this was a good chart, pre 2017 Act, married filing. I'm going to focus on married filing jointly. Married filing jointly, you're at $12,700. Under the Tax Act, you're up to 30,000. So for married filing jointly, and now under the Big Beautiful Bill, it gets indexed up to 31,500 for 2025. So we'll see that benefit for married filing jointly couples, this year, and the rest of the chart you can see.
Rich, you're on mute.
Rich, you muted.
All right, don't know how that happened, but this is like a task of errors this morning. I apologize for everything, but hopefully you're enjoying the presentation. All right, so the senior deduction is, $6,000 for a qualified individual through year 2028 for those individuals over age 65. And it's reduced by 6% to the extent AGI exceeds 75,000, or if you're married, 150,000. This has been touted as the no tax on Social Security provision, but essentially I should take out the word only, it's a $6,000 deduction for seniors, which is meaningful. So one of the things that I know Bill Bodwin always kind of goes through with you is some holistic plan examples. So I jumped on the holistic plan bandwagon and I ran some examples through there for this presentation just to kind of bring it home to you. So this is a senior couple with their adjusted gross income being $155,000. And then you can see here, you've got their senior deduction coming in under the Big Beautiful Bill at 11,400. It starts to phase out a little bit because their AGI is over 150, only goes down by $600, but you can see that that's happening. And then their total tax is 13,266. What this individual also gives $5,000 a year to charity, right? Directly to charity. What if you took this scenario and you had the $5,000 go from the IRA directly to the charity, a qualified charitable distribution? That reduces their adjusted gross income to $150,000 from 155,000, and then basically gives them their full additional deduction, senior deduction for two individual married filing jointly over age 65, so $12,000. And so the total tax is 11,949, which ends up being $1,300 in tax savings. That's meaningful. That's a great conversation to have, if you're not using Holistiplan to kind of like show clients some of the differences in tax planning or things that they could do. It kind of brings it home for them, and it's so easy just pulling in their prior year's tax return. So I thought that was a good example of a senior deduction with the QCD comparing it to the prior year. So then on the SALT limitation, so here the bill increases. So the current in 2024, you were able to deduct $10,000 of like local income taxes, real estate taxes, right? So then before the 2017 Tax Act, that was, you were able to deduct all of those, take all those deductions. But if they were high, that's when, as I said before, you got into that alternative minimum tax calculation. So the 2017 Tax Act took away the AMT applying to lower to middle income clients, right? Now it's only going to apply to really high income clients, like over $1 million of income. And, and then raising that $10,000 deduction up to 40,000. So in that situation, it starts to get indexed over the next couple of years. But then in 2029, it goes back to $10,000. So the bill also provides the deduction is reduced by 30% of modified AGI over $500,000 and fully reduced, at 600,000. And that applies, like we just said before, to single taxpayers and married filing jointly. The good thing is you'll never be reduced below $10,000. So you'll always get the $10,000 deduction. And those income-based limitations, those will apply for this year in 2025, which can be significant in tax savings, for clients. And I think I went through an example in a couple of slides. There's also a permanent non-itemizer charitable deduction for individuals. So under the pre-act law, there was it basically allowed individuals to deduct charitable contributions, without electing to itemize deductions. So basically, it provides $1,000 or $2,000 deduction for a joint return, and to qualify, the contributions have to be in cash, have to be made to a public charity, and certain other requirements that would have to be met. This charitable deduction is below the line, so it's deducted from adjusted gross income and arriving at taxable income. A lot of times we use the term adjusted gross income because that's an indicator for certain services, like whatever that number is for qualifying for, a certain deduction or credit, right, or a certain state benefit. But and then if it's a below the line deduction, it'll have some tax savings, but it doesn't reduce that AGI number up above the line. There was another provision that was put in for charitable giving, and it was a 0.5% floor for itemized charitable deductions. And so it basically is, that calculation, you're just not going to get the full benefit of the full deduction of the charitable gifts that you make. There's a calculation of contributions exceed, like, the deduction is, exceeding 5%, 0.5% of the taxpayer's contribution will be deductible. So it basically gets reduced by a certain percentage for the deduction purposes, which I don't think is that meaningful, but it is a change that was made. The next section that we're going to go through is impact on business owners. And just want to take a quick, go through a quick reminder here about Section 199A, how it applies to our business owner clients and the benefit there. Before the 2017 Tax Act, S corps, LLCs, all their income kind of flowed through to the shareholders, to the members, and was taxed as ordinary income. As part of the 2017 Tax Act, there was a couple of changes. One, C corporations were now taxed at 21%, which is amazing, and great opportunity. And they said, hey, what about the flow-through entities like a S corp and an LLC where the income flows through to the members? There's no tax benefit there. And they're like, okay, what if we give this S corporations and the LLCs an additional deduction? We'll give them a 20% deduction, on their income that flows through from those businesses. But there's some rules that we're going to put in place on that. And this chart actually goes through those real rules, really well. Starting out with, is it a specified service business? So a specified service business in certain industries, like our industry, is a specified service business in finance. So if it is a taxable income over the threshold. Remember, married filing jointly for this year would be 394,600 up to 544,600. So if it is over there, is it taxable income over the full phase-in? So if it is, yes, then there's no deduction. If it's not, then the deduction is just reduced. If it's not, and then so if the income's not over the threshold, then you get your full 20% of the qualified business income deduction. A little bit different for a little bit easier to get the deduction and some other rules of kind of, how to get there and not phasing out, so quickly is if you're not a specified service business, and you can kind of go through the chart and kind of see that. So, the big beautiful bill made the deduction permanent, 20% for business owners. And even though a lot of the things change the same, the fact that from an estate tax standpoint, from a business owner standpoint, from an income tax standpoint, there were things that were made permanent, it actually is making our job like a little easier because when a client says, "Hey, should I set up as an S corporation?" Or a client says, "Should I make a major gift, over to a trust for my family? And I don't have a taxable estate today, but I will next year." Like those, it was a level of uncertainty where we had to put structures in place or kind of hold off on making decisions until we could kind of like, see, what the permanency of the tax law is going to be. Not to say that that can't change with a newer administration, but having some permanency for now and doing the planning with clients, from my standpoint, it makes our jobs like a little easier and kind of narrows down the decision making, which makes it makes those conversations easier. So business owners, the Section 199A deduction was made permanent, and those the phase in thresholds, were changed a little bit. They were increased from 50,000, to 75,000 for single filers, and 100,000 to 150,000 for joint filers. And there was a minimum deduction that was put in place for active businesses. So some of the specified service trade businesses, just for your knowledge, would be like, if we went back to the prior chart, to kind of qualify and kind of go through that chart, it would be health, law, accounting, consulting, financial services, and athletics. So those industries face some limitations, but if you're within those phase ends, your deduction is still available. The deduction is still only available for non-corporate taxpayers, and that's individuals, trusts, and estates. So that means that even though an S corporation, the income flows through to an individual, so that qualified business income deduction is not a deduction for the S corporation, it's a deduction for the individual shareholder. So that's what that means, which is going to kind of tie into, if somebody's phasing out of that 20% deduction, or there's some planning opportunities. One planning opportunity might be to shift some income over to like other family members with business interests, or maybe using a non-grantor trust. Like a non-grantor trust is a trust, where there's a separate tax identification number, its own legal entity. And so you start to shift some income over there, it gets its own, qualified business income deduction, and then possibly can keep, a individual shareholder, out of the phase out, for their QBI deduction. It has to fit in the planning, but it's just certain ideas that you can kind of like keep in mind. Here's another Holistiplan example where we kind of went through, this business owner has about 400 in 2024, 419,000 of taxable income, total tax $118,000. So in this example, I wanted to run through what happened with the sunset with the same tax numbers in 2025. So if the big beautiful bill wasn't passed, even though that wouldn't take effect to 2026, you sunset it, and what the taxes are. And then tax year 2025 is the application of the big beautiful bill. And then what if we increased their taxable income, their business income, by $100,000? What happens? So tax year 2024, they paid $118,000 in taxes. Scenario 3, tax year 2025, just comparing that under the big beautiful bill, same assumptions, $103,000. So there's a tax savings there to the business owner of roughly about $15,000, which is amazing. So that's a compilation of the SALT limitation, the continue of 40,000 compared to the 10, the increase in the standard deduction, and and continuation of the qualified business income deduction because were still not within the phase outs, of their income range. But if you took scenario 3 and compared that to scenario 4, what happens then? This is really important. This is why we do what we do, with clients. So under the big beautiful bill, business owner is doing well, you're meeting with them. He's like, yeah, my you know, income has stayed the same, or my income's about to increase, about $100,000. So the tax goes up by, considering everything else is the same, goes from 103,000 to 159,000. So that's an increase in taxes, of an additional 56% is paid on that $100,000. So even though they're in the effective rate of 31%, that additional $100,000 is a 56% tax. What can you do with that client? You can shift the income, you can defer the income with the additional qualified plan contributions. You can use having some of the business interests may be owned in children's names or using a trust like a non-grantor trust, and you can start to do some tax planning there. So here's an example where the clients have an LLC and we use the non-grantor trust. So remember, there's two main types of trusts, a grantor trust and a non-grantor trust. A grantor trust is one where the grantor pays all the income taxes. A non-grantor trust is one where the income taxes are paid by the trust. So the trust has its own tax ID number, the non-grantor trust, and any income the clients basically gift over some of the LLC interest over to the trust for the benefit of, you can have a spouse as a beneficiary, you can have children as beneficiaries, you shift it over there. And now that trust has, the taxable income of that trust that shifts away from the clients. So that helps kind of reduce down their adjusted gross income. There's a separate SALT limitation of $40,000 for that trust. So that's significant in tax savings. And then there's a separate QBI deduction. So to kind of help the clients from going through a phase out, unless there's, if clients are making a couple of $1 million a year from their business, are they going to be able to, unless they're shifting, they're probably not going to be able to get out of phasing out of the QBI deduction unless they're using a lot of different, separate trusts. And there's actually in some scenarios, where a client is, setting up trusts for children and maybe separate trusts for grandchildren, there's an argument there. It all comes down to the numbers and the cost of setting up the trust and the administration of the trust, right? And the cost of doing that is compared to the tax savings. But you could set up a separate trust for each grandchild and each child and have an additional QBI deduction phase in and an additional SALT limitation of $40,000. That can make that meaningful. So, it just depends on the client situation and example. Just wanted to kind of go through that today. My main point on that is that I think that income tax planning is going to become even more important in our conversations with clients. I think that the provisions that were put into place have created some opportunities that, and remember, this bill was just passed just about a month ago. So thinking through these different opportunities, collaborating with other experts in the industry, just on different things that we could do with different clients. I think it's an interesting time where focusing on income tax planning along with, estate and charitable is going to be equally as important, and it shouldn't be avoided. So, and so more will come from that. So other provisions for business owners, the expansion of the qualified small business stock gain exclusion. So if you were aware of it or not aware of it, if you were issued stock as a C corporation issued stock, the initial issuance of the stock to its shareholders, and you held that stock for a period of time, and then you sold that stock, you could get up to a $10 million exclusion of gain from the sale of that stock. Also, QSBS, qualified small business stock, also referred to as Section 1202. But what happened from the Tax Act under the Big Beautiful Bill, there was an expansion of those 1202 provisions where like the holding period was like 5 years, but now if you sold that stock within the 5 years, like after 3 years, you would still get a 50% exclusion of gain, 4 years, 75%, and so 5 years, 100% exclusion. So it wasn't just 5 years or nothing. So they expanded and they tiered the exclusion percentages. But still, they did a higher asset threshold for C corporations to qualify. And so that used to be if you had a C corporation with more than $50 million in assets, gross assets, then you didn't qualify for the qualified small business stock exclusion. That was raised to 75 million. And then what we saw was the exclusion cap rose from 10 million to 15 million. So what that means that if your client was issued C corporation stock, let's say that after July 4th of 2025, so after the passage of the Big Beautiful Bill, your client gets issued C corporation stock and interest in a C corporation, and that stock growth is initially valued at $1 million. And then when they 5 years later or further, when they go to sell that company and it's worth $20 million, 15 million of the 20 million is excluded from capital gains upon the sale. That's pretty amazing. But it even gets better, just like a Ginsu commercial. So and so you can create multiple $15 million exclusions. You can use non-grantor trusts, with C corporation stock I mean, we're not going to have hundreds of clients each, that this situation will apply to, but we probably each have like one or two that we kind of talk to, that where this could apply. It's basically setting it up right from the beginning, where, client says, yeah, this is going to be a 10 or 20 times, the value of what it's worth today, and kind of thinking through some of the income tax applications as compared to just estate tax planning. And so when I'm working, just a rule of thumb, like when I'm working with a client and I'm thinking through, because sometimes you can't accomplish the income and estate tax planning all at once. And I just worked through with a client where they were pre-IPO and some of the restrictions on transfer of shares. And we wanted to accomplish a lot of income tax planning, and we did. And we focused on that with some vehicles to, save them, millions of dollars in income taxes. And then step two is going to be, post liquidation of some of the stock is going to be focusing on estate planning. I feel like if you miss an income tax opportunity, you can't get it back later on. But if you miss an estate plan opportunity, there's so many strategies that we could use to leverage and transfer that wealth. And sometimes you can do both at the same time, but sometimes you just sometimes the income tax trumps the estate tax. That's how I look at it. I'm glad to talk to you guys at a meeting, conference, over a cocktail and get your opinions on it as well. So other impact on business owners. So we saw 100% bonus depreciation was the immediate deduction of, the purchase of 100% of the cost of most qualifying tangible property, like equipment, machinery, certain improvements, and then increasing the 179 expensing limits. Businesses can now deduct, up to 2.5 million in qualifying purchases each year. And so the differences between the bonus depreciation and expensing limits is like the Section 179 expense limits, there's phase out threshold, but you are allowed to carry over, and you can carry over the unused amounts. 100% bonus depreciation, there is no carryover and there is no annual cap. So just some slight differences there between the two. And then for you ladies and gentlemen who have farmers as client, when a taxpayer sells qualifying farmland to an eligible or qualified farmer, capital gains taxes on the sale can be paid over 4 annual installments. So that was pretty much put in there just to kind of defer out the capital gains that were due on the sale of farmland property, just to kind of ease that burden. Um, I don't know if that's a major impact or not, but that was the reason why that was put in there. And then we have qualified opportunity zones. So I think that some of my so what we knew about qualified opportunity zones in the past, and just to kind of put it into context, you have a client, that sells an asset where there's a large capital gain. A lot of times business owners or the sale of real estate, and they want to defer that capital gain. Qualified opportunity zones were a strategy that we could look at with clients, after the sale in a certain time period to kind of invest, into that qualified opportunity zone as compared to like if you looked at like a 1031 exchange, right? 1031 exchange has to be done before the sale happens. You have to go through all the rules. You have to identify a piece of property for real estate, right? So this was an opportunity to not worry about it before the sale of the business, but take a piece of the proceeds and put it into a qualified opportunity zone investment. Two things happened there over the years is I think we started to get comfortable with some of the investments out there for qualified opportunity zones, because initially when it came out, I just remember a lot of us were having conversations with each other and with vendors about, yeah, the tax savings could be pretty significant, but if the underlying investment, is not that great, is it really worth it, right? So we really wanted to be comfortable with, those investments. And I think we have a couple of vendors, that we have the ability to kind of like work with qualified opportunity zones where they're viable investments. But then we waited, right? So then some of the tax deductions were starting to like phase out, and you were gonna like, if you put in a client into one, today, I don't remember the dates exactly, but your tax deferral was like a year or two now because it was gonna end. So under the big beautiful bill, there'll be an expansion of the opportunity of the qualified opportunity zones with starting in July 1st of 2026. And they'll be they were made permanent. So, and then they did make some changes to what qualifies as a qualified opportunity zone. And I'm not going to go into those specifics, not really for today. There was an expansion of it, also creating a qualified rural opportunity zone, which creates a special rural class of opportunity zones with additional tax incentives to drive investments in less populated regions. Benefits for these, additional step up in basis after 5 years, and and there's more enhanced reporting. And so the changes to the tax deferral is that, the big beautiful bill introduces a permanent rolling 5-year gain or deferral for capital gains invested in new opportunity zones. So that's post 2026. So that means that that means your investment goes in January 1st of 2027, and you get a 10% step up in basis after 5 years. And after 10 years, you get a full step up in basis to the fair market value when you exit. There's some other rules around there, but that's pretty good. Also, it has to be a good investment. And there's so we'll have to see what what those products look like. The tax deferral is good. And there has been some commentary out there that the new rules around qualified opportunity zones, make it a lot more difficult, I guess, for qualifying. So I guess maybe that might be that might change like the investment opportunities that are available. So maybe we may be back to step one again, where we're kind of like looking at whether this is a good investment or not. So it's kind of a wait and see. But clients' money can't go in until January 1st of 2027. So it is, it just gives a little bit of time to kind of think through what this is going to look like and what investments are going to be available. Roth conversions. So Roth conversions still work. Income tax marginal rates, were made, that schedule was made permanent. And so I always like to kind of like look at this slide here where it kind of like just takes a beginning account value with a traditional IRA and a Roth IRA. It was something that I was playing around with in Excel a couple of years ago, and like when you kind of like impress yourself and you're just like, oh, I never really looked at it that way. I was like, that makes a lot of sense. And it's kind of like simple math, right? It's not anything impressive, but figured I'd show it to you. And I've showed it to you before, but like me and seeing different things, you probably forgot. So, here we got a traditional IRA at $1 million and a Roth IRA at $1 million. Let's say with the Roth, you convert today and you're at a 40% tax bracket, you pay the tax now. The net balance, this is paying the tax outside of, within the Roth IRA. We don't make that recommendation. We tell you to kind of like use cash outside of the Roth. But for this example, you net 600,000, and then on both accounts, the traditional IRA and the Roth, you have 200% growth over that period of time. And then when it liquidates upon death, the Roth is tax free, and the traditional IRA, you pay the taxes at 40%. So tax brackets stay the same. You end up with the same account balance. So when we look at Roth conversions, it's the opportunity where we think that a client might be in a higher tax bracket later, and or there's some other reasons where where a Roth conversion makes sense. So some of the top reasons why a Roth conversion makes sense is the taxpayer has tax attributes, carry forwards like net operating losses that they can take advantage of. The client expects that the converted amount they're gonna invest the Roth IRA into an asset that they believe is going to be like a 10x or a 20x of the value that they're in the Roth today. So it's going to grow much more than their other traditional portfolio. The client's marginal income tax rate is likely lower than at distribution. So taking advantage, like looking at I stole this chart for somebody else, but I really like it. So just kind of like, the step pieces of kind of like going from different brackets. And so the easy conversion target is a micro conversion where you stay within a bracket, but you can also step into the next bracket. So if you're in the 22% bracket and kind of going up into 24% bracket, where you're taking into consideration some of those phase outs for net investment income tax and the 199.8 threshold, that's an easy, conversion target to kind of stay within those brackets. And I'll show you an example in a second. Another example would be cash outside the qualified account is available to pay the income taxes, right? So let the Roth, that Roth that was $1 million where they paid the 40% tax, 400,000, paid that outside the Roth account. The funds converted are not required for living expenses or otherwise for a long period. And currently the clients are married, but this is a big one. You look at clients who are married and they have large qualified accounts, IRAs, there's an opportunity to a Roth conversion. It makes sense because when one of those spouses passes away, then the required minimum distributions, start to become, larger later on, or no, the required minimum distributions that come out as it applies to a single taxpayer's brackets is in a much higher tax bracket. So it's just like, it's not an all or nothing type thing, but it's a balance of doing some smaller conversions where over time it can add up and be meaningful. And if the clients owe estate taxes, Roth IRAs always fare better than traditional IRAs from an estate tax standpoint. Here's an example of a Roth conversion. So this client scenario, the first on the left-hand side, this scenario right here, tax year 2025. There's the Roth conversion is included as a wages, 270, Roth conversion of 60,000, Schedule C income of 150, total income 480. So over on the right side, no Roth conversion, so total income is $420,000. And then, where we kind of go down and just the gross income includes the Roth conversion here, and they still get the QBI deductions. You weren't phased out, you stayed within under the phase outs, and the taxable income went to 372,000. So here the total tax was 103,000 as compared to 86,000. So basically a 28% effective tax rate, on, doing that conversion of that additional $60,000 from their IRA. So little things like that can be meaningful, over time. limiting AMT exposure, just kind of go quickly through this because I kind of brought it up before. Really, where I see AMT applying, AMT is going to apply in like two situations most times with our clients. It's going to come back, with clients earning over like $1 million a year for like the phase out. And if they have, a high, real estate tax or estate and income taxes being applied to as deductions. But those are only limited to 40,000 anyways. So on incentive stock options, that's where it kind of applies. I think the opportunity there, and I've talked to you guys about this before, is that when you have clients that are issued incentive stock options, it may make sense before. Usually it's a 10-year, they have 10 years until they have to exercise, right? So usually with an incentive stock option. So maybe exercising, and if you exercise within the AMT exemption amount, so the exemption amounts, went up a little higher for 2025 according to the Big Beautiful Bill. So if we're married, filing jointly up to $137,000, then kind of like, exercising those ISO incentive stock options within that amount or where the exemption amount is going to be can make sense because you're not paying that alternative minimum tax. Once you exercise incentive stock options and you pay that alternative minimum tax, you'll get it paid back to you in a later point in time when you're not in the AMT, and then you kind of get it credited back. But it's like, paying money early and then waiting for it to come back to you in a couple of years from now with no benefit to it. So if you could use that exemption out there on incentive stock options with your executive clients, take a look at that, and that could be meaningful. Wealth transfer certainty for now. So updated the estate tax history chart going back to 1997. We could see the estate exemption going up to $15 million. And we can see the estate tax rate at 40% today. So it's pretty amazing that, looking at, clients and planning for the estate tax planning, if they're not going to have a federal taxable estate, married couple, if their estate's not over $30 million. But it doesn't kind of like stop there because basically you've got to think about some other factors. I'm gonna list those factors in a second, but just take a second here. This was this was the problem kind of doing estate tax planning with clients, is that if you made a gift, it came from the old exemption amount, and we were gonna see in 2026 that this new exemption went away. So unless a client made a gift over $7 million in 2025, they weren't even using the new part of the exemption. So now we don't have an old exemption and a new exemption. We just have a $15 million exemption starting in January. And then we can start to talk to clients about if they want to make gifts, and if they make $100,000 in gifts, their exemption goes from 14 down to 14,900,000, and that exemption will be indexed, each year. Annual exclusion gifts currently right now are $19,000 a year, and they do get indexed. So just a quick rule of thumb for kind of how you go into estate tax planning with clients. You need to, like I said before, you need to coordinate the income tax planning with the estate tax planning. If the client's federal taxable estate is over 15 million for a single, is not over 15 million, but it is over 15 million for a single individual, or over 30 million for a married couple, then consider some gifting and managing the size of the estate. Life insurance is always a great tool over an irrevocable trust. Even if clients don't have an estate tax, but they have a higher net worth, putting that life insurance over to trust and coordinating it with the estate just makes a lot of sense. But if there is no federal estate tax, we have to really consider state income taxes. And if there's a state income tax that applies, what is that state rate? I know in the state of Washington, the highest rate I think goes up to like 34%. That was recently changed. And that's the highest that I think I know of, nationally. And there are a number of states, somewhere around, I'm making up this number right now, somewhere around 14 or 15 states that apply an estate tax. And so we have to look at what that estate tax is going to be and what that state exemption amount is going to be. Then we have to look at what's the basis in the assets that the clients have. and what the capital gain exposure is going to be, and compare that capital gains exposure and capital gains tax. Because if you gift assets over to a trust or to children, you're going to lose that step up in basis in your estate. So it's really comparing the state estate tax for the under $30 million estates, with the loss of step up in basis, and the state is, capital gains taxes. Another idea, with tax planning is client has an operating business. Maybe they set up a C corporation management company for that operating business. So remember, we said before, a C corporation is going to be taxed at a 20% tax rate. So what if we had some income paid into the C corporation? There could be other benefits there too. And then we have a life insurance policy purchased in an ILET, and we have a split dollar design where the dollars for the premiums for that ILET are paid by the C corporation, and they were only subject to a 21% tax rate. So this sounds a little complicated, but what did it accomplish? What you accomplished was an operating business where the clients are in the highest tax bracket. Maybe you have an ability to, take some income, move it into a C corporation where it's paying 21% tax instead of 37. So a 16% delta there, where 16% tax savings, right? And then how do we use that money in the C corporation? Because if we pull it out, it's going to be taxed at the shareholder level because C corporation has two levels of tax. What if we don't pull it out? What if we do an agreement between an ILET and the C corporation, and have the C corporation pay the life insurance premium, for the clients, which is owned in an ILET, which is outside the client's taxable estate. This is a great design. It's nothing new, but based on the tax laws today, it just makes all these components work so much better and provides leverage, an arbitrage, for your client's financial plan. Trump account versus 529. So the new Trump account. So I have a grandniece that was just born this year, so she will be an official recipient of the $1,000, put into his account. And so you have to be born between January 1st of 2025 and December 31st of 2028. You must have a Social Security number. And the federal government will put in one time only $1,000, and you can contribute up to $5,000 a year, which will be indexed by inflation into that account. Interesting, that employers can contribute $2,500, into the account for the individual, and that's not going to be taxable income to the employee. Contributors can be parents, relatives, employers, governments, and charities. Tax benefit is a tax deferred investment growth. When the money comes out of the account, age 18, the funds have to come out of the account at age 18. If it comes out for qualified purposes, like for education expenses, then capital gains apply. If it comes out for other purposes, then ordinary income tax applies. And there will be an ability to roll it over into an IRA. So there are provisions in there for able account rollovers at age 17 for eligible children. And so there was also an expansion of the 529 plan rules. And in the 529 plan previously, you could take out up to $10,000 per year for K through 12 tuition. And now after, beginning in 2026, you can take up to $20,000 a year for K through 12. And the list of K through 12 expenses now includes more than just tuition. It includes books, curriculum, online educational resources, tutoring, and other items. And so this will apply beginning in 2026. And some other provisions that were in there, which we didn't have a chance to really go through today, but the mortgage loan interest provisions were made permanent. There's the permanent repeal of miscellaneous itemized deductions. There's a deduction for the car loan interest, which that's going to phase out for clients pretty quickly. Tax credit for contributions to scholarship granting organizations. I think that's up to $1,700. That'll be interesting. That doesn't start until 2027, I think. No taxes on tips, no taxes on overtime. And then the remaining items are, in the energy industry. And there were a lot of termination of different deductions for energy property efficient home improvements, clean energy, clean vehicles. So there's a lot of changes that were made there that'll be effective starting January 1st, 2026. And now I'm going to open it up to Q&A, just in case you didn't have the opportunity to ask your question beforehand.
Would you be able to, you did such a great job. Thank you very much, Rich. Would you be
You're
able to deliver this content to, most of my business is 401k plans, so for participants or for individual investors. I might be able to do not nearly as good as you, but is that something that we could do, make this investor focused instead of advisor focused?
I think that's something that we can kind of, I mean, it just put together this presentation for today. So I'll definitely be using it for our CPA firms, for, more client focused. But if there's different ways that you want to use it, I mean, why don't we just talk offline and figure that out?
Awesome, thank you.
You're welcome.
Hey, Rich, do we have any partners for QOZs as an investment resource?
We do. I haven't looked at it in the last couple of months, but I think through Steve Colano and or through LPL, there are some vendors on there.
Thanks.
Yeah, sorry, I can't remember who it is off the top of my head. But if you go into LPL ClientWorks and you go to the resources section and you just type in qualified opportunity zone, the list should pull up.
Thank
You're welcome. I'm just putting my email in. It was just requested. Any other questions?
I think there was another one in the chat, Rich, from Tom Portentoso.
So Tom said HELOC interest deduction, is it still limited to borrowers who use the funds from? Yes. So question is the HELOC deduction still limited for funds used for home improvement? They made that permanent. They didn't change it. It was still like a $750,000 combined balance on, the mortgage and the home equity line of credit. But all funds would need to be used for home improvement and couldn't just be used for other purposes. All right, if there's no other questions, I want to thank you for taking the time today and just remind you that this recording will be posted on the Integrated Connection, that this presentation will be available once, since the bill was only passed 30 days ago, it took me until this weekend to kind of finish putting it together. So let me give compliance a chance just to kind of like read through it before we post it up on the Integrated Connection. Is that fair? All right, well, it was my pleasure, and I'm glad to talk to all of you today.
Thanks, Rich.
Thanks, Rich.